Good morning, everybody, and welcome to our release of the first quarter 2022 performance results for FDIC insured institutions. In the first quarter of this year, the banking industry reported a decline in quarterly net income from the previous quarter and the year-ago quarter, primarily due to an increase in provision expense driven by the largest institutions. Just to be clear, provisions are what banks set aside to protect against future loan losses. The increase in provision expense reflects, in part, a slow return to pre-pandemic levels, reflecting an increase in loan balances and evolving economic uncertainties. Though the increase in provision expenses has reduced income, it has also increased protection against future losses. Net income also declined from year-ago levels at community banks because of reduced revenue from loan sales and higher business expenses. Overall, the banking industry continued to report broad-based increases in total loan balances, improved credit quality, and strong capital levels. These factors support the banking industry's ability to meet the country's banking needs while navigating the challenges presented by inflationary pressures, rising interest rates, and the end of pandemic support programs for borrowers. The net interest margin stayed relatively stable and low, declining just 1 basis point from the prior quarter to 2.54%. Most banks continue to report increases in net interest income as a result of loan growth, with more than half of insured banks reporting higher net interest income compared with a year ago. The deposit insurance fund balance was $123 billion on March 31st, relatively flat from the end of the fourth quarter. The reserve ratio of the fund fell 4 basis points to 1.23% as insured deposits grew 2.5%. The banking industry continues to face several challenges, including lingering uncertainties related to the trajectory of the pandemic and any effects it may have on the longer-term health of the economy and the banking industry. In addition, inflationary pressures, rising interest rates, and geopolitical uncertainty could hamper bank profitability, weaken credit quality, and reduce loan growth. Specifically, rising interest rates, which have already contributed to high levels of unrealized losses in the banking industry's securities portfolios, could also lower real estate and other asset values and limit loan repayment ability. These will be matters of ongoing supervisory attention by the FDIC over the coming year. Now, as shown in this first chart, the banking industry reported net income of $59.7 billion this quarter. That's down $17 billion from the first quarter of last year. Most banks reported lower net income this quarter relative to a year ago. The industry reported an aggregate return on assets ratio of 1%, down from 1.38% in the first quarter of 2021. For the first time in a year, provision expense for the banking industry was positive and totaled $5.2 billion in the first quarter. While provision expense increased in aggregate for the banking industry, it still remains lower than pre-pandemic levels. The increase in provision expense was driven by banks with more than $10 billion in total assets. Compared with the industry, community banks reported a lower rate of decline in net income. Community banks' net income was down $1.1 billion or 14% from the same quarter a year ago. A reduction in income from loan sales and increased business expenses drove this decline. Now our next chart shows that quarterly net operating revenue increased 3.9% from the first quarter of 2021 to $214.7 billion. Net interest income continued to trend upward for the fourth consecutive quarter. More than half of all banks reported higher net interest income compared with a year ago. Non-interest income declined slightly by $170.2 million from a year ago, primarily due to a decline in income from loan sales. Now this next chart shows net interest margin for the 5 asset size groups on which the QBP reports. Net interest margin for the industry as a whole stayed relatively stable, declining 1 basis point from the prior quarter and 2 basis points from the year ago quarter to 2.54%. Net interest margin was also relatively stable from the fourth quarter for the largest banks, increased slightly for banks with assets between $10 and $250 billion, and decreased for the 3 smallest size groups. Net interest margin for banks in the 3 smallest asset size groups declined as income earned through the forgiveness of the Paycheck Protection Program loans has declined in recent quarters. The net interest margin for community banks narrowed 15 basis points from the year ago quarter to 3.11%. Now, this next chart shows that banks' holdings of longer-term loans and securities remained elevated at 39.1% of total assets. Although this higher level of longer-term loans and securities helped offset low net interest margins, it also makes banks more vulnerable to rising interest rates. Community banks also maintained a consistent but higher proportion of assets with maturities greater than 3 years to total assets at just over 52%. This next chart shows the unprecedented growth in unrealized losses on investment securities this quarter. The large amount of unrealized losses is a result of the combined effect of the increase in investment securities holdings that offset lower loan growth levels in recent years and an increase in market interest rates. Although the banking industry currently reports high liquid asset levels, the elevated levels of unrealized losses increase the risk of actual losses should banks sell investments at a loss in order to meet liquidity needs in the future. This next chart shows that total loan balances continued to grow for a 4th consecutive quarter, despite continued payoff and forgiveness of Paycheck Protection Program loans. Total loan balances grew $109.9 billion, or 1%, between the fourth quarter of 2021 and the first quarter of this year. The banking industry reported growth in several portfolios this quarter, including commercial and industrial loans, non-farm, non-residential commercial real estate loans, and all other consumer loans, which includes auto loans and unsecured personal loans. Community banks reported a 1.3% increase in loan balances from the previous quarter and a 2.1% increase from the prior year, driven by growth in commercial real estate loans. Excluding the PPP loans, total loan growth rates for both the industry and community banks would have exceeded pre-pandemic average growth rates. The annual loan growth rate would have been 9.2% for the industry and 10.2% for community banks. Now our next chart shows that the asset quality ratios for the industry remain favorable. The non-current and net charge-off rates are only slightly above historic lows. The non-current rate declined 5 basis points from the fourth quarter, driven by reductions in non-current 1 to 4 family residential real estate and non-farm residential commercial real estate loan balances. Annual reductions in credit card and commercial and industrial loan net charge-offs helped reduce the industry's net charge-off rate by 12 basis points from 1 year ago to 0.22%. Community banks also reported improvements in credit quality, with record lows in both the non-current rate and the net charge-off rate. The community bank non-current rate declined 4 basis points from the previous quarter to 0.54%, and the community bank net charge-off rate fell 2 basis points to 0.03% from the year-ago quarter. Our next chart shows that the decline in non-current loans exceeded the decline in loan loss reserves in the first quarter, and as a result, the ratio of the allowance of loan and lease losses to non-current loans increased from 178.7% to 184.3% in the first quarter. This next chart shows that deposits continued to increase in the first quarter of 2022, driven by growth in insured deposits. Uninsured deposits actually declined modestly. Deposits totaled $230.7 billion. That's up 1.2% from the level reported last quarter. Deposits remained elevated compared with historic levels. However, growth rates remain well below the unprecedented levels reported in 2020 and the first quarter of 2021. This next chart shows that the number and the total assets of banks on the problem bank list. The number of banks on that list declined by 4 to 40 institutions, and total assets held by problem banks increased by $3 billion to $173.1 billion in the first quarter. The number of problem banks is at the lowest level since QBP data collection began in 1984, and no bank failures occurred in the first quarter. This next chart shows that the balance for the Deposit Insurance Fund, the DIF, was $123 billion on March 31st. That's down about $100 million from the end of the fourth quarter. This was the first decline in the DIF balance in more than a decade. Unrealized losses on available for sale securities in the DIF portfolio, driven by the rising rate environment, largely offset insurance assessment income. Insured deposits increased 2.5% in the first quarter to $10 trillion. These factors caused the reserve ratio of the fund, that's the fund balance relative to all insured deposits, it caused the ratio to fall 4 basis points to 1.23% as of March 31. Even without the unrealized losses, the reserve ratio would have experienced a decline of 2 basis points due to strong insured deposit growth. Prior to the surge of deposits related to the pandemic, the reserve ratio had not declined in any quarter since 2009. The FDIC adopted a restoration plan on September 15, 2020, that would return the reserve ratio to 1.35%, that's the statutory minimum, by September 2028, as is required by law. A key assumption surrounding the restoration plan was that insured deposit growth would normalize and the surge of insured deposits associated with the pandemic would recede over time. However, more than 1 year after the most recent round of pandemic-related fiscal stimulus, the industry has continued to report strong insured deposit growth, as is shown in this chart. In fact, excluding quarters affected by the increase in insured deposit limits in 2009, and the early pandemic, insured deposits increased in the first quarter by the largest amount in at least 30 years. The FDIC is closely monitoring the factors that affect the reserve ratio and will provide its next progress report to the board in June. Given the continued significant growth in insured deposits, the board will likely consider options to amend the restoration plan, including increases to assessment rates to meet the statutory requirement by September 2028. Overall, the banking industry remains strong at this time. The net income decline reflects higher provision expenses relative to the level reported last year in anticipation of potential future risks. But capital and liquidity remain strong, and in addition, loan growth and credit quality metrics remained generally favorable. At the same time, however, the banking industry faces significant uncertainty going forward, resulting from lingering sensitivities related to the pandemic, inflationary pressures, a rising interest rate environment, and geopolitical developments. These factors could impact bank profitability, credit quality, and loan growth, and will be matters of ongoing supervisory attention by the FDIC over the coming year. That concludes my statement, and I'd be glad to take your questions. But before I do, if I may, I'd like to mention that one of my colleagues taking part in today's briefing, Diane Ellis, who is the director of our Division of Insurance and Research, is going to unfortunately be retiring at the end of this month. And she has served the FDIC for over 30 years with extraordinary competence and dedication. So I wanted to take this opportunity to acknowledge her service, both to the agency and to our country. And I would note that her colleague, Pat Mitchell, who's currently the deputy director for the division, also a long-term career employee at the FDIC, will be succeeding Diane as the next director of our Division of Insurance and Research. So Diane won't have to do any more of these QBPs, but Pat will. And with that, I'd be happy to take any questions you might have.
Thank you, Mr. Chairman. Again, please use the raise your hand feature to ask a question. I'll call on you by name and you can unmute your line. And we, again, invite you to turn on your video. Claire, our first question is from Claire Williams at American Banker.
Hi, thank you guys for taking the questions and congratulations, Diane. Wanted to circle back to these will be matters of ongoing supervisory attention by the FDIC. I was hoping you could get a little bit more specific about what that means. I think you sort of mentioned some macro things such as inflationary pressures, the pandemic, but could you get a little bit more specific about what the FDIC can and will do to put that ongoing supervisory attention on those issues?
Claire, for that question. Look, a rising interest rate environment is going to have, as I indicated in my statement, consequences for asset values that banks have exposure to. I think we're particularly focused on commercial real estate and other assets that are being held on the books of the banks. And also, if a rising interest rate environment should impact overall economic growth, that could have obvious consequences for the loan growth by banks and their other business activities. So we have a shifting economic environment from the past couple of years. We've seen the expiration of the fiscal stimulus support that have benefited the economy and the financial institutions. And so in our examination work over the coming year, we're going to be paying close attention to the balance sheets of the banks, to the assets they're holding in their portfolios, and the impact that the changing economic environment, may have on them. So, as I say, we'll be paying close attention over the coming months.
Claire, go ahead.
Great. I noticed that the assets on the problem bank list remained rather elevated, despite the number of problem banks decreasing again. Could you talk a little bit about that balance? Is it concerning to you that the assets on problem banks are so high?
Frankly, from an aggregate perspective, it really does not, as of yet, appear to present a particular issue or risk. So I would say, as a general matter, not at this time.
And to follow up on that, Acting Comptroller Sue has mentioned on a couple of occasions his concerns regarding bank mergers in regional banks. So is that something that you're thinking about? Have you had those conversations with him? And is that something that you're looking at as well at the FDIC?
Yeah, no, I think is a matter of attention for us as well. As you know, we put out a request for comment on how the agencies review mergers under the Bank Merger Act. And, the risks posed by large regional banks is something that we've solicited comment on in that request for information. A large regional bank failure can present challenging issues in resolution if one should fail, with even potential financial stability risks. So it's something, one, we pay close attention to, and is relevant, as Acting Comptroller Sue indicated, to a Bank Merger Act review, I think.
Again, use the raise your hand feature if you have a question.
And I can keep going if you'll let me. When last week at the FDIC meeting, I noticed that there was some changes regarding the Supervisory Appeals Committee. I was hoping you could talk a little bit more about that decision to change it back. From my understanding, it moved to a process by which people on that committee are appointed more by the regulators as opposed to it being independent. Could you talk a little bit more about why that decision was made?
The guidelines for the review, these are appeals of supervisory determinations that examiners make in the course of a bank examination. The guidelines for the review of the appeals remain the same. We thought it was appropriate. Previously, we had a board-level committee as the ultimate review body for these appeals of supervisory determinations. We thought, from a standpoint of accountability, that really is a sensible approach. The alternative adopted had actually engaged private sector individuals with some examination background, but nevertheless private sector individuals who were under contract to sit in review of supervisory determinations. And from a standpoint of accountability, at the end of the day, we thought a board-level committee was really the appropriate approach for the review of these kinds of appeals.
And looking at the logo issue that was also addressed last week, a couple of board members mentioned crypto specifically, and I sort of went and looked at the crypto companies and how they represented FDIC insurance. I guess is that a big issue that we've sort of been missing, where crypto companies are falsely suggesting that they are FDIC insured? I guess could you talk a little bit more about the connection between that move and cryptocurrency?
Yeah, look, I think as a general matter, we've seen, and first of all, the representation of the FDIC name and logo is pretty important, so that the public and depositors are clear about whether the deposits they're placing are covered by deposit insurance. So we take it very seriously. We've had a statute in place for a long time now that gives the FDIC the authority to enforce compliance with accurate representations of the FDIC name and logo. And this rulemaking that we adopted actually lays out how we will implement the law in terms of the process and review for any misrepresentation relating to the FDIC logo. We were specifically focused in the rule on non-bank companies. That could include crypto, but other non-bank firms that might have an incentive to represent deposit insurance coverage when it may not be the case. So certainly crypto firms would fall within that category that we want to pay close attention to, but it is a broader universe as well.
Give other people a chance if they would like to ask something.
Your colleagues appear to have given you the floor, Claire. We have time for one more question. Again, senior staff will be staying with us, so if you have remaining questions about the financial results that we've reported today, you can stay on the live stream or WebEx following this, and we'll be available to you. Hearing none, seeing none, that will conclude our live stream, and we are going to remain on the line to speak if you have any other questions, but with that, we'll end today's live stream, and thank you for joining today's briefing.